Hi, and welcome to the Trading with Ashley show. You are going to love today's video because it is anchored towards small accounts being able to trade large stock tickers without having to have all the money to sell puts on those particular tickers. What I'm going to teach you today is called a put credit spread, and sometimes you have heard of it as a bull put spread. I'm going to explain all that to you. I'm going to show you how to build this. I'm going to show you the risk reward. I am going to show you how to manage this trade. But most importantly, I am going to explain the risk associated with this trade and try to make sure you fully understand how to take advantage of it, but also how to keep yourself safe. So let's get ready to discuss the put credit spread, and today's stock that I am going to do this with is none other than Tesla. Now, why might I be interested in trading Tesla if I am going to do a put credit spread? Well, for several reasons. For one, you should choose a stock that you believe has a very bright future with upward momentum in the stock. Now, I have a lot of confidence in Tesla. In fact, I love the company so much that I went and purchased a Tesla. But now that I have the vehicle and I am enjoying the full self-driving technology, I am very confident in Tesla's future, especially when it comes to the unsupervised self-driving technology. Because once this becomes more mainstream, if you have unsupervised self-driving, you can actually turn your vehicle into a money-making machine while you sleep. You could send it out to pick up passengers if you're in a city that allows it, and then it could return home to you ready for use in the morning, all the while you literally made money while you sleep. So there's that to contend with. And you also have the potential for the humanoid robots. Now, I know it sounds very futuristic, but just let it play out the whole scenario and listen to how it might catch on sooner than other people realize. Just think about human nature. So what if you go over to your neighbor's home like we often do, and her house is just spotless, but you know she has a full-time job, she has a house full of kids, and you're curious, how does she do it? And she introduces you to her new Tesla robot that actually does some cleaning, some cooking, folding clothes, tidying up around the house. Once you become more familiar and comfortable with the technology because you see others using it, it could really catch on and it could be a game changer. But think about it. At one point, the stove was new, the technology of a vacuum cleaner, a washing machine, a dishwasher, all of that had to evolve over time. And I'm sure when they came on the scene, someone was giving them the side eye until people got more comfortable using the technology. So the future is very bright. So you want to select a stock that you believe in its business model and you have studied it and you think it's going up. So Tesla fits that bill. Let's talk about how important it is that it is a popular enough stock to have what's called liquidity on the chain. What is liquidity? Well, liquidity is the money that's infused into the market, and it allows for this robust exchange of buyers and sellers on an option chain. Now, this is really an important requirement when you are doing a put credit spread because you're not dealing with just one option chain, you're dealing with two. And that's important that it's easy to get in and out of these trades because that's going to provide the measure of safety, and it's also going to put more money in your pocket. It's important that you have a robust chain, and Tesla does have a robust chain. Okay, let's talk about volatility and the role that it plays in doing credit spreads. Now, volatility, when it's high on a stock, like it is with Tesla, basically volatility is just how much this stock can go up and down. And if you've ever traded Tesla, you are trading it because of that volatility. Well, when you are selling puts on a stock with high volatility, you are going to be compensated for that volatility. But that which you enjoy in higher premiums could also be a curse if you put too short of a date on your credit spread, because you need time for a stock to oscillate up and down, as that credit spread will be in profit and out of profit, in profit and out of profit. If you have too short of a window when you're putting on a credit spread with a highly volatile stock, then that could burn you. So we want to, if we're going to do high volatility and enjoy big premiums, we want to go further out, and I'll show you what I'm talking about. finally, before we get into the nitty-gritty details, I want to talk about safety with credit spreads. Honestly, the worst thing that could happen is you put on one or two credit spreads. It's incredibly easy money. The spread expires worthless. You were like, that was too easy. And then you start upping the game. You start putting on 2, 3, 4, 5 times credit spreads because it doesn't take a lot of money and you think it is just an ATM. That is the most dangerous thing that could happen because you could win 10 credit spreads in a row and then you start upping the ante and you start adding to the number of contracts that you sell. Then one credit spread losing will wipe out all of the gains of the 10 credit spreads. So if you are going to trade credit spreads, you must use proper performance management and you must keep your position size reasonable. I always like to tell my community that if you are going to trade credit spreads, you definitely want to start slow and you only want to use a sliver of your available funds to trade them. The most consistent way of building income I have found when you're trading is through the wheel strategy. And so I save the bulk of my funding for the wheel strategy. But every now and then when the setup presents itself, this is a great opportunity to ink even more premium so that you can increase your returns like I have. Now let's go into the computer, let's evaluate this trade, and I'm going to show you how to build it step by step. One of the first things I'd like to look at is their earnings. So you can see that they barely beat their last earnings estimates, but the two prior they missed. Now they are expected to beat. Right here you see that kind of grayed out line right here. It's a little bit higher. It looks like that they are expected to beat it by 0.76. So we'll see how that looks after earnings comes and goes, but you can go right over here next to the revenue versus earnings and get a better indication of what's happening. So clearly they have revenue coming in. That's not the problem. What seems to be stagnant is the earnings. You can see Q1, Q2, Q3 for 2024. This is not near as impressive as it was in Q4 of 2023. Now with just a car fleet right now, that is limited. However, when they add all of these other opportunities into the market that we've discussed, that will more than likely increase their potential earnings. And that's what we want to look at as an investor. Now let's go to analyst recommendations. This one's interesting because you don't see quite as much support from analysts on actually buying this stock right now. The vast majority are saying to hold it, but they do think it's overpriced. Let's look at the price targets. So in the trade I'm about to put on, I am going to be doing a trade that is going to be on the lower end of this. So you see right here, the high end price target is 528. Currently, it's trading at 413. The average price target is 304. In my perspective, based on future opportunities, I like anything with Tesla under 400. And this is well below 400. But the trade that I'm going to put on actually goes below the average price target. So that will be interesting for you because that's a measure of safety if you're going below the very conservative price targets that they have right here. Next, I am going to go evaluate Tesla with technical analysis because this will help me determine the best entry for my put credit spread. So let's take a look at what we're dealing with. Now, I am going to do a longer credit spread, so I'm going to go ahead and look at a year's worth of data. That's going to be helpful as it gives more time for a stock to oscillate up and down. Let's go ahead and clear some of these markings here. This was a lesson that I had done with some of my students. We'll clear that. Now you can see it a little bit better. One of the first things that stands out to me when I'm looking at this is my eyes go right here to this 200-day moving average. Now, when a stock that has a lot of price movement has a 200-day moving average that is sloping up, that's a very bullish sign for a stock. So our RSI is at 53. So this stock right now, if you're trading it, it's in a bullish mode. And it's trading really right above the middle part of its Bollinger Band. So that illustrates that right here. This middle of the band is your 20-day moving average. But we're not quite as concerned with that because this trade is going to go further out. And so what we really want to do is focus, like I said, right here at this 200-day and make sure that this stock is trending up. And we are trading well above a sloping up 200-day moving average. So that's going to help us in our thesis that this is continuing on an upward trajectory. We're now going to go build our trade, and we are going to ensure that we're under this all-important $300 level. Once I get to an option calculator, I am going to put in the data to determine my chance of profit and the credit that I will receive and my ultimate risk for putting on the trade. Now, I like going several months out because this allows for a longer time for me to be right. Now, Tesla is a volatile stock. It will bounce up and down, and when it goes up, since this is a bull put spread, when it goes up, I will cash this trade in early. So I'm looking at June the 20th to open up the trade. Now, remember, when we're looking at strike prices, we were right about here when we were looking at that 50-day moving average. So I am going to go well below that. I'm going to start this trade off by selling a $280 strike price put. Now, you may say, wait, $280 a share times 100, that's $28,000 that I would need. Well, that would be the case if you were just selling the put. But to make this a bull put spread, I'm going to turn around and I am going to purchase a $270 strike price. Now, the reason the $280 is the one that I'm selling is this one is more of an expensive option. So I'll sell this one, and then I'll buy this one, and I get to keep the difference. Well, what is that difference? It's right here. It's $172 would be the credit that I'm getting for this trade. Well, how much can I lose? How much does it take to put this trade on? Well, the way you figure that out is you take your opening trade, 280, and you subtract your trade that you are purchasing, 270. The difference between 280 and 270 is $10. You multiply that by 100 because we are dealing with lots of 100. So you would need about $1,000 in your broker to put this trade on. Now, that's a lot different than the $28,000 if you were just selling the put. So you're going to get this credit up front. Your max loss is that $1,000 we just mentioned minus your credit. So the max potential loss on this trade, if you were to have Tesla by your expiration date go through both strikes, would be $827. Now, what are our chances of profit? It's right here. It's showing you 84%. So there is an 84% chance that on June 20th that Tesla is above 280 in a strike price. That's where our chance of profit comes in. Well, what's this break even right here? I thought 280 was the magic line in the sand, and this says 278. Well, what this is looking at for you to break even, it's considering that you did receive this credit right here. So an even trade would be if it settled in at about 278, the amount that you would lose would be equal to this 172 that you received earlier. But obviously, we're not in this trade to lose money. We want to make money. And so for us to win 100% of the trade, we would have to see the trade to the very end, June 20th, and Tesla would have to be above 280. Well, if we have strong earnings with Tesla or they start rolling out some of these opportunities we have been hearing about, then Tesla will more than likely be trading much higher as we get closer to June 20th. And if so, you can have more confidence to allow this to continue to play out in your favor. But if we have stayed stagnant or worse yet, we're going down closer to the strike price, then you would want to abandon the trade if we get anywhere near this 280 level. So I would say if we get anywhere near about 310, you might at that point decide if you want to go ahead and get out of this trade to keep yourself safe, especially if that were to happen very early on in the trade. Now, one thing you can do to increase the amount that you are getting in a credit for the trade is to adjust your strike prices. So for a measure of safety, I personally would not go any higher than 280 at this point, but you could take the one that you are buying down. Let's say you take it to 250. Okay, so this is going to give you more in a credit, which that sounds great. However, you're increasing the distance between your two strikes, so that's going to increase your max loss and the amount of money it will take to put on the trade. So all these things need to be considered before you place the trade. Also, the further down you go for this leg of the trade, the liquidity, the amount of traders that are trading at the 250 mark for a put is much smaller. So it might be very difficult to get in and out of this part of the trade as you get closer to expiration, especially if Tesla is trading up in these upper levels right here. So these are all things to consider when you are putting on spreads, and you can kind of play with the figures here to determine your risk and then your reward. What kind of a return are we looking at? Well, here's how you would figure that out. You would take this 172 right here, and you would divide it by the max loss, which would be 827. Once you do that, that equals 0.207. So if you multiply that by 100, that will show you your percentage. So this would be a 20% return on capital, which is really nice if you're considering that we're just going to be in this trade for a matter of about 5.5 months. But you could go ahead and shut this trade down earlier and accept less of a percentage, obviously, and then you could rinse and repeat, and you could put on a new Tesla trade if you decide to shut this one down at the 50% mark. Now let's go into our brokerage account and let's build this trade. I am in the Tradier brokerage, and I like using this one for my spreads because they just make it very easy to build a spread and then to monitor it. I'm at 6:20 for the expiration date, and I'm going to go down here to my opening trade, which was 280. You can see right here, if I were to sell this put, I would receive about 1081 for selling that put, but you want to go ahead and do the purchased put at the same time so that it's not going to require enough capital to just have this trade open without this protective trade right here. Now for this one, I'll be receiving about 880. And these are estimates. We're going to send it to a ticket to see what it actually looks like on a ticket. This is considered a multi-leg trade because you're dealing with two trades. And here's how it looks on your ticket. Here's your dates. Now the dates match for each of the legs, although you do have different strike prices. For this first one, it's 280. You are selling this put, sell to open, one contract. For the second leg of the trade, you are looking at 270 for the strike price. It's a put, but this one you're buying to open, and you'll do one contract. When you put that together, it's going to give you a preview of what you're looking at from a credit standpoint. So it's showing you about $1.72. So what you want to do when it's time to execute the trade, you want to change this to net credit, because this is a credit we're expecting, and then you would populate your credit right here. So I'm going to put in 172 because that's the midpoint. When you do the preview, you see right here, this is the proceeds that I'll receive for the trade, and it's telling me that the trade is going to cost $828, which is $1,000 minus the 172. Earlier, I had mentioned to you that a lot of traders, to keep their trades safe with credit spreads, because they can get away from you if you're not watching them, is to go ahead and put in the opposite order to close it out once you've realized a 50% credit. So here's how that would look. After you have already put the trade on, then you go and grab the trade and you populate it for the opposite order. So here I have the 280. Initially, I had sold it. Now I would be buying to close. Going down to the 270, I had initially bought it and I would do sell to close. Now it's turning the trade from a credit trade to a debit trade. You're having to pay to close it. Well, I wouldn't want to go and just pay what I just received. However, I'd like to calculate about 50% of what I received and make that my debit trade to close it out. So to do that, you would do net debit, and half of the 172 would be about 86 cents. So here you would put 86 cents, and then instead of day, you would make this good till canceled, because this trade will go ahead and stay out there, and then when this premium that you received, the 172, whittles down to 86 cents, either due to price movement of Tesla or time decay of the option, it will automatically sell it and get you out of the trade, and that will keep you safer. And once that happens, then you can rinse and repeat, push this trade out further. Now, Tesla may be trading higher, it could be trading lower, but you can adjust your spread accordingly so that you can continue to push out new trades, keeping them far away from the actual action. That will keep you safer. If you want more exposure to the different strategies I teach, and you want to be part of a very positive and robust Discord trading community. Consider clicking the link below. You'll book a very brief call and you'll be able to talk with one of my team members. They will actually go and show you Discord. They'll show you where I put all my trades, how it works, and you can take a look at everything and see if you're comfortable with investing in yourself and being part of this community. We would love to have you. I'd love to welcome you with open arms on my next Ashley Live. And if you liked learning how to trade credit spreads, I think you'll really love this next video I've picked out for you. You can watch that right here.